here's like a street smart question. I gave you a little hint, okay? If you had 5 widgets in inventory, you bought 10 more and sold 8, how many should you have on the shelf? And if you went to the shelf and counted and it was different, why could that be? So take a minute, think about it. Okay, so does everyone agree with this math? Begin inventory 5 plus 10 is 15, minus 8, 7, right? We should have 7. So in the real world, when you go out there and you go count, what do you think? Am I always going to find 7 there? Why wouldn't you? Give me some reasons why you wouldn't find 7. Yeah, you could have made a mistake. Yeah, people be stealing, like people be stealing. Yeah, like that's a big one. Okay, theft. Like as we saw, like with Target, it's a low margin business. Okay, so theft really affects these businesses, right? If they even had like 5% of the inventory stolen, which is I guess a lot, that's gonna like kill all their profit. It's quite a huge expense for these businesses. So yeah, stealing. Uh, if it's some if it's something that goes bad, right? If it's food, if this the widget is a food, it spoils, right? So things can go badly with inventory. It can go bad. It can get lost. You can have a miscounting, and it gets stolen. Okay, so we need some way of accounting for that because right now, if we don't do anything, our inventory asset is going to show 7 units. And if there are only physically 5, then we're puffing up our books, right? We're going to be misstating our assets. We're going to be saying it's worth 100, but it's only really worth 70. Okay, so we need to do something about that. So, uh, we have this word or this term shrinkage, but shrinkage is a term that has to do with all this stuff that happens to inventory: theft, spoilage, damage, errors. Okay, so all these things are going to get tossed into this blanket category of shrinkage, which is basically the loss of inventory for reasons other than selling it. The way that we find this out is through physically counting inventory. There's no other way. If we're relying on our accounting books, we would never find this stuff because this is like physical, actual reality things that happen in the real world that our accounting books aren't accounting for. So we need to physically link up our accounting books with the physical reality by doing a physical count. Okay, so the form of the adjusting entry. So you can see here, this is happening at the end of the period. Okay, so your business will go in and periodically count the inventory and see if it lines up with your accounting books, and it's often not going to. And the difference is going to be reflected in an adjusting entry at the end of the period. Okay, so you can see here that we're taking an expense, cost of goods sold, and we're reducing our inventory. That's basically accounting for this loss that we're taking from all these things here. This. It has to be, it's an expense for our business, right? When all this stuff happens. So you can see the form of the adjusting entry takes that form. We're losing inventory and we're taking an expense. So this is reducing our net income, right? This is reducing our profitability. And so the bigger this is, the bigger the hit is going to be to our profit. Here's the transaction. So your unadjusted balance for inventory is this. So this is what your unadjusted inventory balance is in your accounting system. When you actually go in at the end of the period and you physically count the items, you realize that there's only this much value of inventory. That's you saw how many units over there. You have some per unit value, and you saw that the value of your inventory is only this much. So think about what is the adjusting entry required to account for this. Okay, so take a second, try to write it down, see if you remember. Let me move this down. And is inventory going up or down based on this? Because right now what we're saying is that it's right now 10,560. So this is what it should be after the adjustment. So we know that we're going to debit or credit inventory. Credit, right? So we need something here. Okay, so what is that number? How should we calculate that? Who wants to help Roger? Okay, so what is that? I didn't do it, but who did the calculation? Yeah, 730. Okay, so we know half the journal entry we already got. It's going to be inventory, credit, 730. So then what should we debit? What does it represent? I mean, is it good or bad for my business that this happened? Bad, right? So what are we going to do? What is the account? An expense. And what expense account are we going to use? Cost of goods sold. So when you see cost of goods sold on the income statement, is yes, it is the buy low, sell high. It's the buy low part of it, but it's also all this other junk. All these other losses are going to be kind of thrown into that cost of goods sold. So this is our adjusting entry as of, dated December 31st. And that will make our inventory balance correct. It'll bring it down to this value, which is what we're going to put on our balance sheet. And our income statement is going to have this extra loss because, it is a loss for our business.